Welcome back to the channel. Today we're going to talk about contract for difference trading or CFDs. Many people always see CFDs on their broker platform and never understand what they are about. So in this video, we will lift the veil and give you some understanding of CFDs. By the way, with my broker, you can start trading with just $5. Sign up with the link in the description box below if you want to give them a try. This is good for anyone wanting to test a Forex robot or trading strategy in real live market conditions without putting too much capital on the line. Please also subscribe so that you will not miss our future videos. Also see the links in the description box below if you also want to download free Forex robots, indicators, courses, and books. Now let's get back to our video. A contract for difference, or CFD, is a form of derivative trading. CFDs allow a trader to speculate on prices of global financial markets, such as shares, indices, commodities, and of course, currencies. While trading CFDs, a trader gets to bet on both upside and downside movements of the market. The profit and loss for CFD are calculated by taking the difference between the entry and exit prices and multiplying it by the number of units. CFDs always come with an expiration date, before which you need to close your position. Trading these CFDs may appear sophisticated and complex in the beginning, but once you start trading them, it becomes easy to handle. Leverage trading CFDs. CFDs are a leveraged product, which means a trader needs to maintain an optimum level of capital in their trading account to execute a trade. As it is leverage or margin trading, this capital can only be a small percentage of the full position's value. While margin trading allows a trader to magnify the returns, losses will also be more as a trader will lose leverage times the capital he is betting on. Hence, it is always recommended to go for less leverage. If you are a novice trader, we suggest you not to go beyond 2x leverage. And obviously, the gains and losses will be based on the value of a CFD contract. Costs involved while trading CFDs. There are three types of costs a trader may incur while trading CFDs. 1. Holding cost. At the end of each trading day, mostly at 5 p.m. New York time, if the positions are open in your account, it will be subject to a charge called holding cost. Holding costs will depend on the CFD, direction of the position, and the holding rate. 2. Spread. CFDs always come with a spread, which is the difference between the buy and sell price. This price is decided by the broker, and it varies from broker to broker. A trader will have to enter a buy trade at the buy price quoted by the broker, and exit using the broker quoted sell price. The narrower the spread, the less the price needs to move in traders' favor for their profits to start. These spreads are extremely competitive across all the brokers. 3. Market data charges. For getting live market feed and accurate prices, a trader must pay the relevant market data subscription fees. However, this fee is mostly applicable to stock CDFs and varies from broker to broker. Things to remember when trading CFDs. Like any other market, there are high risks involved in trading CFDs as well. CFDs are complex in nature, at least for novice traders. They carry a high risk, so it is important to do your research before you start trading. Also, since CFDs are leveraged products, losses can easily exceed your total investment. In volatile markets, your account balance can drop down to zero or even to a negative balance in no time. Following best trading practices like properly applying risk management to your trades will increase the chances of profiting. And that's it for today's video. We hope you found it helpful in understanding CFDs. Remember, always keep learning and growing as a trader. As always, if you have any questions or comments, please leave them below. And don't forget to subscribe to our channel for more trading tips and strategies. Thanks for watching.